All right, so let's jump into this deep dive you wanted to do into investing in 2025.
Yeah, this roadmap thing.
A roadmap,
Yeah.
exactly. And I know everyone listening, like me, we're kind of overwhelmed with advice.
Absolutely. There's so much out there.
So we're going to try and cut through the noise, right, and look at something practical.
Exactly. Practical.
This YouTube video that you sent me.
Oh, yeah, yeah. The one that, claims to have the secrets that all the wealthy people.
Yeah, the wealthy people use.
Oh, yeah, right.
So we're going to look at it, but with a very, practical lens. What can we actually get out of this?
Right. Like, what can we use? What can we actually implement?
Exactly, exactly. So they start out with this statistic that 63% of Americans can't even cover a $500 emergency.
Oh, wow.
Which really kind of underscores their first point, which is optimize your cash flow.
Yeah, that's huge.
Not very sexy,
But no, but it's the foundation.
absolutely it's the foundation.
Yes.
So how do we do that?
Well, they emphasize tracking expenses, and I think that's really key, like knowing where your money is going.
Yeah.
Whether you use an app or a spreadsheet,
Personally, I'm so bad at that.
Yeah.
It's like I buy a coffee here, I buy
Especially those little things.
especially those little things, exactly. And then it's like, where did the money go?
Yeah, you just swipe, 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 and you're like, where'd it go?
Exactly.
But, the expert says that just becoming more aware of your spending habits, you can save 10 to 15% potentially.
Wow.
Without even making major sacrifices.
That's pretty good.
Yeah, just knowing where it's going.
Like finding hidden treasure in your budget.
Exactly. Plugging those leaks.
Yeah, okay, cool. So then the next thing they talk about is tackling your high-interest debt.
Right. And they point out that, the average American has over $22,000 in debt.
Yeah, that's crazy.
It is. It's a big number, but they offer two methods for tackling it, the avalanche and the snowball.
Oh, I love that.
Yeah.
So explain those.
Okay, so the avalanche method
Yeah.
is focusing on paying down the debt with the highest interest rate first.
Okay,
Because obviously that's going to save you the most money in the long run.
long term.
Yeah. And then there's the snowball method,
Yeah.
which is more about prioritizing paying off the smallest balances first, just so you kind of get that psychological boost.
You get that win.
Yeah, you see it going down.
I used the snowball methods when I paid off my credit card debt.
Nice.
And it really felt good. Even though they were small amounts, it's like, yes, one down. Next.
Yeah, you're making progress.
You're making progress, exactly.
So it really depends on what works for you, I think.
Yeah,
But the key takeaway is high interest debt can really hold you back.
yeah,
You need a plan to get rid of it.
absolutely. So step 3, the thing that I think we all love to talk about, harnessing the Roth IRA.
Right, yeah, the Roth.
Which the expert says can really be, a game changer.
Yeah, especially if you're younger and you have time on your side.
Oh, yeah, they say time's your biggest asset, right?
It really is when it comes to investing.
Yeah.
Because you want that money to grow over time. And this is a great way to do it tax-free.
Tax-free, exactly.
So yeah, with a Roth IRA, your money grows tax-free. You can withdraw it tax-free in retirement.
Amazing.
Which is awesome. So they mentioned the contribution limit is $7,000 per year.
Yeah.
But the real magic is in the compounding.
Oh, yeah, it's like magic.
It is. It is like magic.
Like watching your money make money.
Exactly. And I give an example where, let's say you start at age 20.
Okay.
You consistently contribute the max, which is that $7,000.
Uh-huh.
And you earn, let's say, an average of 8% return, which is a reasonable return over the long term.
Yeah.
By retirement at 65, you'd have over $3 million.
Yet.
I know, right?
That's incredible.
And that's the power of starting early. Of course, not everyone's going to earn 8% every year.
right.
But the point is, the long-term benefits of a Roth are huge.
Huge. Okay, so that's a lot of information already.
Yeah, we're just getting warmed up.
We are. So the next step that they talk about is building a diversified investment portfolio.
Yeah, and they warn against those get-rich-quick schemes.
We've all seen those.
Yeah, right. You see them all over the internet.
Everyone's promising you're going to be a millionaire in 6 months.
Yeah, follow my system and,
I think we all have that little voice in our head. It's like, what if I find the perfect stock?
I know. What if I just pick the right one?
And then I'm set for life.
Right.
But, realistically,
No, it's just not how it works.
it's not.
And even professionals struggle to beat the market consistently.
Right.
So the expert actually recommends index funds
Okay.
as a simple way to diversify.
So what is an index fund?
Okay, so an index fund is basically a type of mutual fund
Okay.
that passively tracks a specific market index like the S&P 500.
Uh-huh.
So you're not trying to pick individual stocks, you're buying a basket of
You're
stocks.
spreading it out.
Exactly, you're spreading out your.
Yeah.
And they specifically mentioned Fidelity, which has no-fee index funds.
Oh, that's great.
Yeah, which is awesome because fees can really eat into your returns.
Yeah.
And you know what's even more interesting?
What?
The expert's own portfolio, like the person giving all this advice,
Yeah.
is just 2 index funds, 80% S&P 500, 20% international.
Wow, it's that simple.
I know, right? You'd think they'd have some crazy complicated strategy.
With all the secrets.
Yeah, right? But it shows they're really committed to diversification and long-term growth.
Simplicity.
Exactly.
Okay, so we've optimized our cash flow, tackled our debt, looked at the Roth IRA, and diversified our portfolio.
Yeah, feeling good.
What's the last step?
All right, the fifth and final step is all about consistency.
Consistency.
And they call this dollar cost averaging.
Dollar cost averaging. Okay.
Which basically means investing a fixed amount at regular intervals.
Got it.
Now, this is where they acknowledge that investing can be emotional,
Oh, yeah?
especially when the market's going up and down.
It's a roller coaster.
It is, and it's easy to panic sell when things are going down.
Totally.
Or get greedy and buy when things are going up.
Yeah.
But they emphasize that you really have to stick to your plan.
It's all about the plan.
Yeah, regardless of what's happening in the market.
Discipline. Exactly. Discipline.
Don't let your emotions make your financial decisions.
That's right. That's right. And they actually share some stories
Uh-huh.
about people who sold at the wrong time, either during a crash or when they thought it was the peak.
Oh, I've heard those horror stories.
Yeah, and then they missed out on potential gains because they tried to time the market.
Oof.
So the takeaway is stay consistent, write out those ups and downs,
Yeah.
and don't try to be a hero and time the market.
Easier said than done.
It is, but it's the key to long-term success.
Okay, so this is all about laying a solid foundation, right?
Yeah, like slow and steady wins the race kind of thing.
Exactly. It's not about those overnight riches. It's about consistent action and discipline.
Right, it's a marathon, not a sprint. Okay, so this expert's 5-step plan sounds pretty solid.
It does.
But do they actually practice what they preach?
That's a great question.
Let's take a look at their own investment portfolio and see if it really is a model for building wealth.
All right, let's dive in.
Let's do it.
I'm curious to see what they're doing.
Me too.
All right, so they break down their portfolio into like 4 main categories.
Okay.
And the first one is 35% in residential real estate.
Wow, okay.
Yeah, so they bought a bunch of fixer-uppers
Fixer-uppers?
between 2011 and 2020.
Oh, so a while ago.
Yeah, and they renovated them, and now they rent them out.
Okay, that sounds like a lot of work.
It is. It's FRA a hands-on approach.
Yeah.
But they say, their timing was really key
Uh-huh.
because they snagged those properties when interest rates were super low.
Oh, that makes sense.
And they locked in 30-year mortgages at those low rates.
Smart move.
Yeah, so now they have this stable income stream with the rental properties.
Yeah.
Plus, they're benefiting from the appreciation of the property values.
Okay, so it's like a double win.
It is, yeah. It's a classic wealth-building strategy, and it really aligns with their emphasis on consistent cash flow.
Got it.
Like, it's not passive income, but it can be really rewarding.
If you're willing to put in the work.
Exactly.
All right, so 35% in real estate. What about the rest of their portfolio?
Okay, so another 35% is in those same index funds.
Oh, the ones we talked about.
Yeah, the 80% S&P 500, 20% international.
Okay.
And they're holding those for the long haul.
Long haul. How long are we talking?
Like 20 to 30 years.
Wow. Okay, so they really walking the walk with this whole buy and hold thing.
They are. They're not chasing fads or trying to time the market.
Yeah.
Just consistent investing in a diversified portfolio.
Let time do its thing.
Exactly.
So that's 70% accounted for. What about the remaining 30%?
All right, so 20% is in cash.
Cash. Okay.
Yeah, so this includes things like treasuries, high-yield savings accounts, money market funds.
Got it.
And they're currently earning like 5.2% to 5.3% on these.
Whoa, that's a lot of cash, though.
It is. I know. You might think they're missing out on potential growth in the stock market.
Right.
But they say it provides liquidity for expenses and opportunities.
Uh-huh.
Like if something comes up, they have the cash on hand.
I guess that makes sense.
Yeah. And also gives them peace of mind.
Peace of mind.
Yeah, they can sleep at night knowing they can handle unexpected costs.
Without having to sell investments at a bad time.
Exactly. Exactly.
And, I mean, earning over 5% on cash isn't bad these days.
No, it's not negligible.
All right, so 20% cash, and then the final 10%.
Okay, the last 10% is in alternative investments.
Alternative investments like what?
So this includes things like, a small amount of Bitcoin.
Oh, Bitcoin. Interesting.
Yeah, but they call this their fun category.
Fun category.
Yeah, it's like their play money.
So they're not, like, relying on it for their retirement.
No, not at all. They acknowledge that some of these investments might not pan out.
Yeah, some of them could be risky.
Right, but they're willing to allocate a small portion just to see what
It's
happens.
like a little experiment,
Exactly, they're exploring those potentially high-growth areas.
but without putting their core portfolio at risk.
Right, it's a calculated gamble.
I like it. It's like a side hustle for their portfolio.
Yeah, that's a good way to put it.
So overall, their portfolio seems pretty well-rounded.
It is, yeah. They're not all in on one asset class or strategy. They have that solid foundation with real estate and index funds,
Uh-huh.
combined with a cash cushion for stability.
And a little sprinkle of alternative investments for fun.
Exactly. I think it's a great example of how you can create a portfolio that matches your own risk tolerance and financial goals.
Yeah, I'm impressed.
Me too. It shows they've really thought this through.
I'm curious, though, about one thing.
What's that?
They bought those rural properties when interest rates were super low,
Right.
but now rates are rising. How do you think that will impact their real estate strategy going forward?
That's a great question, and it's definitely something we should explore further.
Yeah, because the real estate market is sensitive to interest rate changes, right?
It is, and it'll be interesting to see how their strategy adapts to this new environment.
All right, well, let's dive into that then. So we were talking about how rising interest rates could impact this expert's real estate strategy.
Yeah, it's definitely something to consider. They got in at a good time with those low mortgage rates.
Super low, like, wow, good for them. But what about, like, going forward?
Well, it makes things a little trickier, right? Because for new buyers, higher mortgage rates,
Oh, yeah.
it's a tougher pill to swallow.
Yeah, might make them sick twice.
Exactly, so demand could cool down.
But wouldn't that also be good for them if they want to sell?
It could, less competition,
Yeah.
but possibly lower sale prices too.
Oh, so it's a trade-off.
Yeah, kind of a double-edged sword.
But they did say they're in it for the long haul, right?
Uh-huh, they're not looking to flip those properties.
They want those rents coming in.
Exactly, that steady income.
And their mortgage payments won't change, right?
Yep, locked in those rates.
Smart move.
Big advantage, especially compared to someone buying now.
Oh, yeah, for sure. But what about, like, finding new tenants? Will that be harder?
Actually, it might be easier.
Really? How so?
Well, if buying becomes less attractive, more people might be renting.
Makes sense?
So more demand for rentals, maybe even higher rents.
Oh, so that could actually work in their favor.
It could, yeah.
Interesting how it all kind of balances out.
Yeah, every change has its pluses and minuses.
Okay, so that's rising interest rates.
Uh-huh.
What about that potential economic slowdown? We talked about that earlier.
Right. That's a big question mark.
Could that hurt their real estate game?
It could, definitely. A slowdown, job losses, less spending.
People not moving as much?
Exactly. So demand for housing, both buying and renting, it could take a hit.
So rents could go down?
It could stagnate, yeah, maybe even decline.
Not good for a landlord.
No, not idea, but remember they've got those long-term tenants.
Right, some stability there.
And those low fixed-rate mortgages, those help too.
So they're kind of protected, at least somewhat.
Yeah, they've got some built-in buffers, for sure.
So even if things get a little rough, they're probably going to be okay.
They're better positioned than someone who, say, just got a big mortgage at a high rate.
Or who's relying on, like, short-term rentals.
Right, those are much more vulnerable.
Their approach seems very, like, stability-focused.
Yeah, definitely resilience is key, especially when things are unpredictable.
I feel like we've really gone deep on this, haven't we?
We have, yeah, not just what they said, but like really thinking it through.
Yeah, like how it all actually works in the real world.
And that's what matters, right?
Totally. So what are, like, the big takeaways here for everyone listening? Like, what can they learn from this expert, especially with all these, like, potential challenges ahead?
I think the main thing is slow and steady wins the race.
It's a marathon, not a sprint.
Exactly. It's not about getting rich quick. It's about building that solid foundation.
Yeah, and being consistent. I like how this expert talked about that a lot.
Yeah, consistency is huge, both with investing.
And with managing your money.
Uh-huh. And I also like their focus on cash flow.
Those rents coming in, that cash cushion, it gives you options.
Peace of mind, too, knowing you can handle whatever comes up.
Yeah, that's huge. I think a lot of people stress about that.
For sure, and it lets you ride out those market storms, not make rash decisions.
Yeah, not panic sell everything when the market dips.
Exactly, and that's a key part of long-term success.
It's inspiring to see someone actually living by what they preach.
I agree. It makes their advice more believable.
Yeah, they're not just saying stuff, they're actually doing it.
Walking the walk, not just talking the talk.
Exactly. Okay, well, I think we've reached the end of this deep dive.
Yeah, we've covered a lot of ground.
We unpacked their 5-step plan, looked at their portfolio, thought about those interest rates and the economy.
Hopefully everyone listening feels like they can take action now.
Start building their own path to, financial success.
Absolutely. And remember, it's a journey, not a destination.
You don't have to be an expert overnight. Just start with the basics.
Track your expenses, get that debt under control, invest consistently.
Pick a strategy that feels right for you, and your goals.
And most importantly, never stop learning.
Yeah, stay curious, keep exploring.
The world of finance is always changing, so stay engaged.
That's great advice on that note. Until next time.
Keep diving.
Keep diving, everyone.